Most people treat debt and credit scores like two completely separate things. They stress about their debt over here and worry about their credit score over there. But here is what nobody explains clearly. Your credit score is not just a random number. It is a direct reflection of how you handle your debt. And if you understand how one works, you automatically understand how to fix the other. In this video, I am going to break down exactly how debt management and credit scores work together, why your score is where it is right now, and the step-by-step path to taking control of both at the same time. Let us start with the credit score, because most people misunderstand what it actually is. Your credit score is a three-digit number somewhere between 300 and 850. That tells lenders how risky it is to loan you money. The higher the number, the more trust you have built with the financial system. A score above 740 is considered very good. Above 800 is excellent. Below 580 means lenders see you as a high-risk borrower and either refuse you entirely or charge you much higher interest rates as compensation. But here is the part most people skip. Your credit score is not one single measurement. It is calculated from 5 different factors, and each one carries a different weight. If you do not know what those 5 factors are, you are essentially trying to improve a grade without knowing what is on the test. Factor 1 is payment history. This is the single biggest factor, and it makes up 35% of your total score. Every time you pay a bill on time, a credit card, a loan, anything, it gets recorded as a positive mark. Every time you miss a payment, a late payment gets recorded and it damages your score significantly. One missed payment can drop your score by 50 to 100 points, depending on how strong your profile is. The lesson here is simple. Pay every single bill on time every single month, no exceptions. Even the minimum payment counts. Missing a payment is always worse than paying the minimum. Factor 2 is credit utilization. This makes up 30% of your score. Credit utilization is the percentage of your available credit that you are currently using. If your total credit limit across all cards is $10,000 and you currently owe $4,000, your utilization is 40%. The rule of thumb is to keep utilization below 30%. The best scores typically have utilization below 10%. This means carrying high balances month to month actively hurts your score even if you're paying on time. Paying down your balances is one of the fastest ways to raise your score quickly. Factor 3 is length of credit history. This makes up 15% of your score. The longer your accounts have been open and active, the better. This is why financial advisors often tell you not to close old credit cards, even if you do not use them. Closing an old account shortens your average account age and can lower your score. Keep old accounts open. Use them occasionally for small purchases and pay them off immediately. Factor 4 is credit mix. This is 10% of your score. Lenders like to see that you can handle different types of credit, responsibly credit cards, car loans, student loans, mortgages. Having a variety of account types works in your favor. You do not need to go out and take on debt just to improve your mix, but it helps to understand why having only one type of account limits your score ceiling. Factor 5 is new credit inquiries. This is the final 10%. Every time you apply for a new credit card or a loan, the lender runs what is called a hard inquiry on your credit report. Each hard inquiry temporarily lowers your score by a small amount, usually around 5 to 10 points, and stays on your report for 2 years. Applying for multiple credit accounts in a short period looks desperate to lenders and signals risk. Only apply for new credit when you genuinely need it. Now let us talk about debt management, because having debt is not automatically bad. The problem is not debt itself. The problem is the wrong kind of debt at the wrong interest rate with no plan to get out of it. There are 2 proven strategies for paying off debt, and both of them work. The question is, which one works for you? The first strategy is called the Avalanche Method. You list all your debts from highest interest rates into lowest. You make minimum payments on everything, and then you throw every extra dollar at the highest interest debt first. Once that is gone, you move to the next highest rate. This method saves you the most money in interest over time. It is mathematically the most efficient path out of debt. The second strategy is called the Snowball Method. You list all your debts from smallest balance to largest. You make minimum payments on everything, and then you attack the smallest balance first, regardless of interest rate. Once that is cleared, you roll that payment into the next smallest. This method gives you faster wins, which builds momentum and motivation. Research shows that people who use the snowball method are more likely to stick to their payoff plan because progress feels real early on. Neither method is wrong. Avalanche saves more money. Snowball builds more momentum. Pick the one you will actually stick to. There is one more thing you need to know that connects debt management and credit scores directly. As you pay down your debt balances, your credit utilization drops automatically. As your utilization drops, your credit score rises. As your score rises, you qualify for lower interest rates on future loans. Lower interest rates mean less money going to interest and more money going to paying off the actual balance. This is the debt and credit cycle working in your favor instead of against you. The single most powerful move you can make today is not complicated. Set up automatic minimum payments on every account so you never miss a due date. Then aggressively pay down your highest utilization cards first. Those two actions alone will improve your payment history score and lower your utilization score simultaneously, the two biggest factors in your credit profile. Debt management and credit scores are not two different problems. They are the same problem with the same solution. Pay on time, pay down balances, stay patient. The number will follow.